From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday the 13th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. My co-host today in New York, Kaylee Lyons. Alix Steel has a well-deserved day off. Kaylee, here we are, Friday the 13th, the only one this year. Stocks don't care. The S&P inching ever higher.
Another record high, Guy, the 48th one of 2021 thus far. I'm having a lot of fun keeping count. We'll see if we can continue to hold on to these gains as the session grows older. Right now, the index up just about 0.1% at 44.64. One individual stock I'm watching in today's session is Disney. Of course, it reported after the bell last night. There was so much concern about the Delta variant and the impact it was going to have on the park segment of its business. It was totally fine. Plus, they have 116 million subscribers to Disney Plus. So that stock up more than 3%. We are seeing yields ticking lower on the 10-year. We're down a little more than 3 basis points now, 132.36. If we do indeed end higher on this Friday, then on Monday, we will have the second consecutive week of advancing for yields, which is the first time that's happened since back in March. And it is a weaker dollar story across all of G10 today, Guy. The Bloomberg Dollar Spot Index off by around 0.2%.
Is Delta, you bring it up, denting consumer sentiment? Let's find out. The University of Michigan Consumer Sentiment Index dropping onto my Bloomberg as we speak. The headline number, a significant miss on expectations. The prior number, 81.2. We dropped to 70.2. The expectation was 81.2, so no change, so a significant drop there. Current conditions, 77.9, so that is definitely down from 84.5 last time around. Again, a miss. It's the forward-looking expectations part of the equation that I think is really interesting. 65.2 versus the 78 expected, 79 previous. One-year inflation expectations remaining stubbornly high at 4.6%, down from 4.7, but nevertheless elevated. 5 to 10, up to 3%, Kaylee. We'll dig into the details of the data in just a moment with some analysis. Apparently, I hear rumors, I have no facts to substantiate this, that this is Janet Yellen's favorite indicator, her favorite piece of economic news. It is her birthday. This seems appropriate.
Rigging in 75 today. I'm not exactly sure this is the kind of data that the Treasury Secretary wants to see, though, this dent we are seeing in consumer sentiment. So happy birthday, Janet Yellen. Maybe this doesn't make you the happiest on this birthday, but certainly we hope that for her, Guy. And of course, Janet Yellen has been making the case consistently about the need to invest in this U.S. economy through Biden's long-term economic spending. And we do have news on that today. 9 moderate House Democrats say they will not vote for the budget resolution until the infrastructure bill passes. They sent a letter to House Speaker Nancy Pelosi yesterday saying, with the livelihoods of hardworking American families at stake, we simply can't afford months of unnecessary delays and risk squandering this once-in-a-century bipartisan infrastructure package. It's time to get the shovels in the ground and people to work. Here with the latest is Bloomberg's Washington correspondent Anne-Marie Hordern. So Anne-Marie, what's a House Speaker to do when you have the moderates on one side and the progressives on the other?
It's going to be a very delicate dance, Kaylee, when they come back from recess on August 23rd. And it's shaping up to be contentious because she can only afford to lose 3 votes. And right now, it doesn't look like she has them in either way, with these 9 moderates putting a threat to pen and paper, saying we will not get on board with the budget resolution and reconciliation if bipartisan infrastructure is signed into law on the president's desk and has a signature. But of course, we know the other side of her caucus, the progressives, say they're willing to tank bipartisan infrastructure. This is really their leverage to use against the moderates if they do not see budget reconciliation. That's really their leverage against those moderates in the Senate, their colleagues like Senator Joe Manchin of West Virginia or Kyrsten Sinema of Arizona, who say that $3.5 trillion is just too much of a top line. So August 23rd is really starting to shape up to be a very important week for the House, their own party, this little bit of a family infighting. Speaker Pelosi is going to have a lot of work to do.
Yeah, but as we all know, families can fight tooth and nail. And I suspect that's probably what we're looking towards here. It's going to be interesting to see how far this process gets pushed out and when the money finally gets delivered. AMH, great stuff. Thank you very much indeed. Bloomberg's Anne-Marie Hordern joining us from D.C. I want to get back to the data, which looks like it's been pretty much dinged up by the Delta variant. University of Michigan sentiment numbers coming in well below expectations. Let's talk to the man now who leads the team putting together this data, Richard Curtin. Richard, thank you very much indeed for joining us. Is that what I'm seeing here? Is this a Delta effect?
It is, and but thanks for having me back. And I think we should look at this set of data as something that consumers delivered on Friday the 19th. The sentiment index in early August recorded the third largest monthly decline in nearly a half century. It was down 13.5% from last month. And it pushed the index to below where it was in April 2020, which was our low for that recession. And, by comparison, there was the other two larger declines were first in April 2020 when the shutdown took effect. That was 19%. And then during the depths of the Great Recession, we recorded an 18% decline. Now, these losses covered all income, education, and regions of the country, including all age groups, and covered all aspects of consumers'
So, Richard,
views.
Yeah, if sentiment is waning, what is that going to mean for their tolerance to price increases and the inflation side of the equation?
Well, Guy mentioned that we had a little change in the expectations of year ahead and 5-year inflation. And actually, they've been really unchanged for since May. They've been at these high levels. And, and I think, that evidence doesn't bear on the case of whether the transient nature is there or not. But consumers in August, as they did in the several months prior to that, have complained about high prices for homes, vehicles, large household durables, and this has caused them to adopt negative attitudes towards spending. Now, I think, this will help curb some inflation in product pricing because they're not going to buy, and they've already turned down home sales and vehicle sales. Of course, vehicle sales had other problems. So I think it will help, but I think it's too early to tell.
Can I ask you a question about how this breaks politically? If I look at this data through a political lens, are red consumers, blue consumers looking at the world differently as a result of, A, what is happening kind of in Washington, D.C., and what is happening in their world right now as we see maybe some vaccinated, some unvaccinated? I'm just kind of wondering how we can look at this data differently to get an idea of what kind of impact we're going to have.
It is true that Republicans are more negative than Democrats on the outlook for the year ahead. But we have to understand that if we look at the change from last month to this month, each of those groups, including independents, fell by similar proportions. So this has been a widespread decline. And, it is not simply due to reason, but also emotion played a big role in this. And, the extraordinary surge in negative assessments was due to their response to the COVID and their dashed hopes that the pandemic would end soon. So I think this emotional response is likely to fade as we gain control of the Delta variant in the next several months.
Well, I'm curious as to how this translates through to income prospects. The gauge of expected personal finance fell to a 7-year low. Where does that stem from?
When we look at the details, lower income folks have expressed larger gains that they expect during the year ahead, and upper income households expect lower gains than they did in the year ahead. And I think this is due to changing wages for low income workers, but also to what Biden has proposed. But I think the problem with those income gains, which have been more generous on the low end, is that when we look at the reasons people give for their finances, eroding living standards were more likely to be voiced by those 65 plus, those in the bottom third of the income distribution and those with the least skills or least education in the labor force. So this is a difficult time.
All right, thank you so much for your insight into what consumers are thinking and feeling. Richard Curtin, University of Michigan Director of Consumer Sentiment Surveys. Again, the University of Michigan August Consumer Sentiment preliminary read 70.2, well below expectations, the lowest, in fact, since 2011. And on the back of that data, we are seeing yields moving lower around session lows on the U.S. 10-year and session lows in the equity market as well. But yes, we are still at a record on the S&P 500. We will discuss whether or not the gains will continue with Sarah Hunt of Alpine Woods. That's coming up next. This is Bloomberg. Live from New York, I'm Kaylee Lyons along with Guy Johnson in London. This is Bloomberg Markets. While earnings season still underway and Disney surprised investors with better profit and subscriber gains, Airbnb's outlook, though, was not quite as sunny. Bloomberg's Abigail Doolittle is looking at the results. And Abigail, this really goes to show you there's a lot of sides to this kind of reopening narrative.
There certainly is mixed gains. And to your point, we have reopening and stay-at-home stocks kind of mixed here. And Disney, point in case, they're kind of the hedge for both sides, though. If you take a look at Disney, shares had been even sharply more higher earlier, up more than 4%. Not bad right now, though, up nearly 3%. To Kaylee's point, really strong quarter there. Streaming subscribers of 116 million, beating the estimate, but also their parks, the first profitable quarter going back to March of 2020. So you have that stay-at-home piece in the streaming, and then you also have the reopening piece in the parks. But it gets a little bit trickier when we take a look at Airbnb. They put up a strong quarter. Their guidance not great, though, so that is probably more of a reopening stock, not doing great. And then Context Logic, Wish.com, e-commerce, stay-at-home, their guidance not great. So you have management teams seeing some clouds for the third quarter, but where we're not seeing any clouds, we're just seeing up and away. Streaming subscribers for Disney, again, 116 million in the third quarter, more than 100% growth on a year-over-year basis. So really growing through the pandemic, and even now as the reopening is starting, we have streaming continuing to go higher. And then finally, if we take a look, play it forward to next week, Guy, lots of retail names out next week. On Tuesday, we'll have both Walmart and Home Depot. On Wednesday, we'll have Lowe's, TJ Maxx, Target, and others. And then Thursday, Macy's and Estee Lauder. So I guess this will really be more of a tell on the reopening. Are folks out there? And now we have that interesting consumer confidence print. So these retail earnings will be front and center next week. Everybody wanting to know what's happening as consumers get back out there, Guy.
Absolutely. We're going to spend a lot of time talking about that next week. Abigail, thank you very much indeed. Some great coverage coming up with the retail reporting season. Let's talk about what is happening right now with these markets. We inch ever higher, despite it being Friday the 13th. Katie's very annoyed that I keep bringing that up. Sarah Hunt, Alpine Wood Portfolio Manager, joining us now to give us her take on this. Are you reopening or are you stay at home?
I think you have to be, this is going to sound terrible, but you have to be a little bit of both, because we are going to reopen. The question is, now that we're getting closer to September, is there a possibility that school gets pushed out? People have been talking about whether or not that's going to happen. Are cases peaking? There's some question about that, because if they are, then you shouldn't have a problem so much with schools reopening. I think you're going to reopen. The question is just, are you going to drag this out a little bit longer? And what is that reopening going to look like? Because everybody was expecting a huge explosion, but you've had sort of a stop-start situation with reopening. So I think that you're still going to see some of those stocks react well, but there's going to be some concern about what happens going forward.
So Sarah, if it's hard to kind of gauge where the peak in cases is, can we at least gauge where the bottom was in that lagging behind of the kind of cyclical reopening trade? Have we seen Treasury yields in that reopening trade bottom for now?
Yields are a very tricky situation right now because you've got a lot of different things that are pushing against them. You've got very low yields across the world. You've got the question about whether or not the economy is going to be stronger or strong enough to handle a change in this whole question about when we're going to taper, when we're not going to taper. I don't know that we've seen the bottom in yields. I think it's entirely possible just from a technical standpoint, but I also think that the reversal of that and yields going straight up in a straight line, I think is also under question right now.
Sarah, let's introduce Delta into this conversation and talk a little bit more about it. If we see Delta continuing to have an effect on the U.S. economy, and you only have to look at the University of Michigan data we've just seen to see the effect that it's already having on consumer sentiment, can we assume that the taper gets pushed out and therefore we are going to have more liquidity, which in theory should be good for stocks?
I think that's the big question, and I think that's one of the reasons that you saw yields change. And so you had that big employment number, right, very recently, but I think that's a little bit backward looking because that was happening before we started to see a resurgence of cases. So the question's really going to be, was that the sort of peak of the reopen, and has the Delta now slowed that down, and you're going to start seeing it not just in confidence numbers, but also in employment numbers, because we haven't seen that yet? Or is that confidence just knocked because everyone's starting to talk again about whether or not we reopen or close, and just the fear factor of, are we going to be living with different variants? Are we going to be getting vaccinated? I mean, I think in the end, we are going to have to learn to live with different variants, as Mohammed Al-Arian was saying earlier this morning. And the fact that you're going to have, booster shots and everything else, that's going to be part of the story. But I think right now there's some fear that's going along with that.
So there's all these fears, all these potential tail risks out there, and yet we're at our 48th record high of the year on the S&P 500. Is all that needs to matter earnings?
I think earnings are definitely a big part of it, but the liquidity argument also comes into play. So you sort of right now you have both of those things, right? You have very good earnings and fairly good outlooks. I mean, even Airbnb is not getting hit that hard. And I think that there's reason to be cautious on some of those outlooks because there's a question about how much travel is going to happen and everything else. The earnings have been coming in really well. The problem is going to be on the supply chain side and on whether or not margins are going to get squeezed because of higher employment costs and because of component shortages. You'll see a short-term squeeze, but if that becomes a longer-term squeeze, I think that's more of an issue.
I think Kaylee's got the almanac open on her desk. The amount of data is very impressive. Sarah, let's talk more about earnings. We've clearly seen the E outperforming the P. That's why the market, in some ways, has continued to be able to be comfortable with the valuations that we're seeing at the moment. You point to that forward guidance. Do you think when do you think we're going to be able to make a view that we are getting towards or have already hit peak earnings?
I think that's also going to be a little bit tricky because it depends on who you are and where you sit in the supply chain, right? So you're starting to see some of the commodity stocks and some of the commodity companies get very high earnings because you've seen some of the prices of things like copper and steel rise. The question is really going to be, how does that all fit together? And are the inflationary pressures as transitory as the Fed wants to believe, and as the market, quite honestly, wants to believe? Because again, this is going to come down to margin pressures, and you're going to be able to take some slowing of growth if you don't have margin degradation. But if the margins start to come under pressure, I think that's going to be a little trickier, and that's going to be in different sectors at different times. But that's sort of where the question of, is this really transitory inflation or not, is going to start to really become a bigger problem for the market.
So talking of margins and the pricing power different companies have or do not have, what would you want to own here specifically?
Well, there's a number of things that we like. We like the financials, and that also sort of says that we expect the yield curve to not stay as flat as it is right now if you like the financial sector. I think there are other places within technology that we like, that we think you can get good value. We like a company called Akamai, which has added a security business to its internet routing business. It's one of the longer standing companies in the internet space. We think there are places where you can find some interesting combinations of growth and value, and that sort of gets back to that growth and value argument that was happening earlier as well. And there are some companies that, for whatever reason, stall their growth and have to find new ways to achieve it. I don't think that the technology stocks are going to become completely out of favor in any sort of permanent way. There's definitely been a rotation occasionally out of them and into the more cyclical stocks as people thought about reopening, but I don't think that that's a permanent shift.
All right, Sarah Hunt of Alpine Woods, appreciate your time today. Happy Friday. Have a good weekend. Thank you so much. And still ahead, investors are moving money into equities. We're going to take a look at what the flows look like, how it's breaking down. Dave Wilson will be joining us. Stay tuned. This is Bloomberg. Live from New York, I'm Kaylee Lines along with Guy Johnson in London. This is Bloomberg Markets. And Guy is very focused today on the fact that it's Friday the 13th, but to me it's just another Friday, and that means we have to talk about ETFs for ETF Friday. The S&P 500 is set to rise for the second week in a row as investors are moving money right on over into equities. Bloomberg's Dave Wilson is taking a look at the flows and the developments in ETFs. Dave, what you see?
Well, you see plenty of money moving into stock funds, no question. Among the top 5 in terms of inflows, 4 of them in one way or another touch on the stock market. A couple of S&P 500 ETFs, Vanguard's Total Stock ETF, and the Financial Select Sector SPDR ETF. So that industry group, which really, as much as anything, is tied into interest rates. But the other piece of it is what's going on with investment-grade bonds. That iShares iBox investment-grade corporate bond ETF, the ticker LQD, with a $2.3 billion inflow. And what's notable there, as much as anything, people are willing to put up money. In fact, the most since the June of last year, even with yields on bonds in the corporate market coming down. If you looked at LQD specifically, I mean, just a couple weeks ago, it hit a yield that was pretty much a record low, less than 2.4%. And I guess people are willing to take yield wherever they can find it at this point.
Dave, you talked about the flows, and I guess we should probably talk a little bit about ultimately where those flows ultimately end up. The ETF world obviously paying a great deal of attention, with JP Morgan converting around $10 billion in mutual funds into ETFs. Can you just walk me through the mechanics of that move and why it's happening?
Well, I mean, it's a process, and we've seen that to some extent elsewhere. Firm Guinness Atkinson converting a couple of mutual funds in March, Dimensional Fund Advisors moving over 4 funds in June. And now JP Morgan's kind of joining the pack to that extent. We're talking about a real estate investment trust fund. We're talking about a fund that is in smaller and mid-sized companies, and then another one for international stocks, and finally a fund that owns bonds and also inflation swaps. But I'll tell you, I mean, this whole idea of active ETFs, Kathy Wood has certainly become known for the ones that she manages at ARK Investment. There's still kind of a rarity, though, because, you have to disclose your holdings. And there aren't a lot of fund managers that necessarily want to do that, which would explain, when you go through active funds, less than 2% of the money under management now is in ETFs.
Mr. Wilson, sir, interesting facts. Yep, Dave Wilson, thank you very much. What do we got coming up for you? Tom Gimbel, LaSalle Network founder and CEO. We're going to be talking about what is happening in the labor market, the war for talent. It is the most aggressive he has seen in 25 years. Kaylee, University of Michigan having a pretty big effect.
Yeah, the lowest read in 2011, very disappointing. That is showing up in a big way in this market. Session low for Treasury yields, down nearly 6 basis points to 130. Still, though, the S&P 500 at a record high. This is Bloomberg.
Well, there is a risk that the labor market is actually tighter than what we think it is.
Hiring in recreation and travel, which is a sector that's been hardest hit by COVID, is up 50% relative to the end of 2020. That's a lot.
So it's going to be a few thousand people that we're hiring. It's going to be very dependent on the surge of traffic that we are expecting.
It is a challenge in the U.S., and I think it's definitely something we see, particularly on the supply chain.
I think we're not far from full employment, and certainly the tendency of wage growth to be accelerating, especially when you adjust for the quality of workers.
That is just a sample of some of the people that we've been talking to about what is happening in the labor market. It is an issue for just about every company right now. Every conversation that I have with a C-suite executive at the moment seems to include some sort of issue surrounding the availability of labor. Is it going to abate anytime soon? How fierce is the war for talent? Tom Gimbel, LaSalle Networks founder and CEO, joining us now. LaSalle is a staffing and recruitment firm. Tom, how bad is it?
Well, how bad or how good, right? It depends if.
Well, depending on your point of view, I guess for you guys, it's pretty good.
It's really good for us. It's really good for the country. The labor market is fantastic, but that means that supply and demand isn't in effect, and the supply is low, and that's going to increase wages, and demand is really high. The interesting thing is we're seeing a lot more demand for lower wages, mid and lower wage jobs versus mid and higher level jobs, which comes down to, retail. It comes down to customer service and call center and help desk and the IT departments. Those types of jobs are really hard to find people right now.
Well, and when we're talking about lower wage jobs, how low are those wages still? To what extent have they had to increase?
Well, as minimum wage has increased and we've moved forward, I'm headquartered in Chicago. We're up to $15 an hour now. Companies are paying $16, $17, $18 an hour. There does get to be a point where companies are going to say, this job isn't worth $24 an hour, and we'll figure out how to pay people. Overtime is time and a half, right? So if minimum wage is 15, you're going to be paying people $22.50 an hour to come in. So you get to this point of where you can get people to work overtime versus bringing in more people and really trying to find where that intersection is and what makes the most economic sense for the company. Remember, the role of a company is to deliver returns to shareholders. And then we have employees who, how do we motivate them to come into work? How do we motivate them to stay at a job? How do we motivate them to come interview? And those are the challenges we're facing. As Larry Summers said in that piece, we're almost near full employment. And that gets to be a really interesting dynamic.
Yeah, we've still got relatively high unemployment. There does seem to be a skills gap, Tom. And I'm wondering how companies solving that?
So there's two things that happen. Number one, we have high unemployment that's directly related to the pandemic. And that is such a unique issue that it's hard to do, but you almost have to look at it separately and say, sans the pandemic, I think unemployment, if you get rid of hospitality and the airlines and people that were in those industries, I've never seen more white collar, I've never seen such a low unemployment rate for white collar workers as we're experiencing right now. The skills gap comes in that, companies have tremendously always valued college degrees. So now we're getting to a point where companies are saying, okay, we'll look at people who don't have college degrees, which will again take the unemployment rate lower as more people are available for those jobs. But the skills gap on the mid to higher level jobs, that doesn't just go away overnight because the jobs are open and we have more job openings than people. You don't create a supply chain person, demand planner out of nowhere. You don't create somebody who can write code in Python out of nowhere. So there is a challenge with the skills gap.
Talking about this from different sectors, I feel like I am reading story after story now about the shortage in workers in hospitals as the Delta variant gets worse. When you look at the healthcare sector, just how extreme is that?
It's really a real challenging issue. What you have with healthcare is when you can't find people to do the lower level jobs, all of a sudden you're going to be having people who at a higher level have to do those lower level jobs under the care of patients. So you have nurses or PAs who aren't going to turn their back on patients because there aren't people to do the more menial jobs. And what we have is this whole problem of immigration coming in. And at the lower level jobs, we have for the past 4, 5, 6 years, this huge challenge of we've got to halt immigration at the border. And then on the flip side, on the higher level jobs, we've got to stop immigration from coming in from countries for college degreed people, and we're sending them back after they get educated here. So we've got this intersection of what do we really want as a country and as employers? Do we want people who can do and want these other jobs? Or are we saying no, and then we're going to suffer because we don't have people to do that work? And so there's a lot of people that say, I'd love to have a job, but I don't want to be at the bottom of the food chain. We live in a little bit of an entitlement generation or entitlement world right now. And I, for one, don't think it's generational. I think we've got entitlement issues from baby boomers down to Gen Zs, and it's really just affecting our country and probably globally.
One of the entitlements that people are increasingly looking for is the option to work from home. How big a factor is this in terms of the hiring process?
Well, it really depends on what's going on. It is a huge issue. And as you know, we're dealing with the Delta virus as that comes and more information becomes available and the third shot and all of those things that none of us are doctors and can comment on in an educated fashion. But what we are seeing is more and more companies wanting to hire people, even if it's work from home, in their geographic area near an office, saying that eventually, whether it's 2 or 3 days a week or 5 days a week, you're going to be coming into the office at some point in time. So the remote work is not as hot as it was a year ago or even 6 months ago. Companies are wanting people to be closer to the office. And that challenge of the employee thinking that I can get whatever I want, we're starting to see that wane, even though it's such an employee-driven market right now.
So does that mean business leaders no longer have to offer super juicy incentives to get people in the door?
What it means is they don't have to offer those to everybody. And that's where the big challenge is versus a year ago, is that if you have skills that are in demand, whether you're a heart surgeon or obviously they need to be in the office, but if you're a software developer or a salesperson and you're the best, you're going to have more ability to get what you want. But if you're a rank and file employee, part of the engagement is if a company's paying you money, you got to go to where the job is. And we've got a little bit of this conflict right now because employees think, because we've been doing it for 15 months, they can get whatever they want. And we're going to see whether it's when interest rates rises, if that affects the employment market, or if we hit full unemployment and we start bringing offshoring business. I think what we'll start to see is more companies of all sizes will start offshoring business to businesses outside of the country where we can get workers to do what we need when we need it done.
Yeah. Be interesting to see how the politics works all the way around that. Tom, final question from me. Labour has played second fiddle to capital for a very long time. Do you think what we're seeing now is the start of a shift in the opposite direction, or do you think this is just a temporary blip?
I think it's a temporary blip. I think you can't have labor if you don't have capital to pay for it, and you got to have money to be able to grow and invest. And people, I was doing a speech to a group of folks, non-C-level, to rank and file workers a few months back, and I said, if you don't like the rules that are set up, then you have two opportunities. Go find a place with different rules or start your own company and make your own rules. But otherwise, we've got to follow where the capital is. And that's what employees do. And right now, we've got this really just unique intersection of coming out of a pandemic, interest rates at an all-time low, and because of last year and just the global nature of the economy, things are moving faster than ever before, but it'll settle down. It might not be for 2 years, and we'll see what happens with the infrastructure package just domestically, but eventually it'll get back to normal.
All right, super interesting insight into this labor market and the hiring trends we're seeing out there. Tom Gimbel, LaSalle Network founder and CEO, thank you so much. And we'll have more on the hiring challenges with Ian Siegel. He is ZipRecruiter CEO and co-founder. He'll be joining Bloomberg Television at 4 p.m. in New York, 9 p.m. in London later on today. And coming up, another hit to already fragile supply chains. China partly shuts the world's third busiest container port after a worker is infected with COVID. We'll discuss with John Wobensmith, Genko Shipping CEO. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Rishika Gupta. U.S. regulators have authorized giving an extra coronavirus vaccine dose to the most vulnerable people. Americans with weakened immune systems will be allowed to get the third shot. They include organ transplant recipients and patients with conditions like cancer. In Afghanistan, the Taliban is putting more pressure on the embattled national government just weeks before the U.S. military ends its mission there. Taliban forces captured 2 major Afghan cities. They're now estimated to hold over 2/3 of Afghanistan. Meanwhile, the U.S. plans to send in some 3,000 troops to help evacuate some personnel from the American embassy in Kabul. China isn't happy with global health officials' plan for a deeper inquiry into the origins of the coronavirus. China says the World Health Organization's plan isn't based on research and is politically motivated. In recent days, Chinese state media has also ramped up a campaign to push the conspiracy theory that the U.S. military pathogen lab at Fort Detrick in Maryland could have caused the pandemic. A coronavirus outbreak has partially shut one of the world's busiest container ports, and that's led to concerns that the rapid spread of the Delta variant will lead to a repeat of last year's shipping nightmares. China shut one of the terminals at Ningbo Zhoushan port after a worker came down with COVID. That terminal accounts for about 1/4 of the container cargo through the port. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Well, staying with supply chain pressures and the issue of that port in China, let's talk about the impact it could have on shipping costs. What we're looking at here is container freight rates from Shanghai to Rotterdam, Shanghai to Los Angeles, and Shanghai to New York. And you can see how they have shot higher in 2021, particularly from May until right now around July. For Shanghai to Rotterdam and Shanghai to New York, we're now looking at rates of about $14,000 per 40-foot container. The question is, if the ports are shutting down in China, specifically at a port that is the world's third largest container port, is that going to make this even more exacerbated? Joining us now is John Wobensmith. He is CEO of Genko Shipping. Genko is the largest U.S.-based dry bulk shipping company. It has global offices in New York, Singapore, and Copenhagen, and it transports commodities like iron ore, grains, and cement. So, John, thank you so much for your insight on this. I know you aren't affected directly by this container port, but it is a huge port. What could the ripple effects be for global trade?
Look, I think in general, as you said, the ports that we ship our products to, iron ore and soybeans and corn in particular going into China, have not been affected. What is interesting is that the Chinese have, in my view, done a pretty good job of getting this wired, in the sense that their port workers, they actually isolate for the most part from the general population. And what I mean by that is they stay on site, they stay in the port, in dormitories, those types of facilities. So I think they're way ahead, way out in front of this. With the specific container port, again, it's not something that we call, but I do know that port, that terminal, is simply being bypassed for other terminals. Now, what that does is it creates port congestion, which we've all been dealing with during COVID, and I do see that increasing, which will have the effect of pushing freight rates higher, whether it's in dry bulk or the container side.
John, good morning. It's Guy. I'm curious as to what the current situation is. How long are ships being stuck outside ports? How long are ships taking to unload and load? Where is the bottleneck here, not just in China, but globally?
Yeah, well, and it is globally. So you can look at whether it's shipping iron ore from Brazil to China. You're seeing congestion both in Brazil, much heavier congestion in China. You know, in some cases, we're waiting 20 to 30 days to discharge an iron ore cargo. You're also seeing congestion in Australia, because what has been put in place is not only a slower port situation, but there are also quarantine periods. So when a ship arrives in Australia, it has to be away from a port for at least 14 days. And so sometimes, particularly if you're refueling in Singapore or what have you, you may have to wait a few days just to even get into the lineup. And as I said, what this is doing is it's pushing freight rates up and shipping costs up.
Yeah, rates are going higher and higher. How long do you expect that to continue, or how high could we see the cost of shipping go?
Yeah, so that's always the big question. I can tell you in dry bulk, you know, we are entering in general into a seasonally strong period. So COVID or no COVID, the second half of the year, third quarter, early fourth quarter in particular, you see more iron ore being shipped from Brazil. Brazil usually ships 20% more iron ore in the second half of the year than in the first half. So there is a lot of seasonality that is occurring, as well as the port congestion that I spoke about earlier. The other aspect that is unique to dry bulk is we have a very low order book. In fact, it's a historically low order book in terms of the number of ships that will be delivering over the next 3 years. We're at only about a 5.9% of the overall fleet. So it's very low. So there is definitely growth in demand. There is definitely elevated congestion, but there's also a very favorable supply situation in terms of there aren't a lot of new ships that are coming online over the next few years.
John, there are indications that the Chinese authorities would like to slow down the domestic steel industry. Are you seeing any evidence of that?
Yeah, I think we're seeing a little bit of that. I think I'll go into the seasonal trend. You typically see steel production slow down anyway from November through February. That's just normal seasonal. They do it for environmental reasons in the winter months, but you also see slower construction activity. There's a little bit of there isn't a direct correlation necessarily to the steel industry and iron ore. We still continue to see a lot of iron ore imports. So, and I think China is, quite frankly, they have quite a balancing act to walk here. And what I mean by that is the price of their steel right now is clearly elevated. It's high. It's very much demand driven. So there's a real balancing act again of trying to curtail steel production, but also not pushing prices even higher when you've got real underlying demand there.
All right, well, John, you mentioned construction. That brings me to infrastructure. Still a question mark as to whether or not infrastructure is actually going to get through Congress. It's looking quite difficult in the House. But if it does, you are a big importer of cement. How do you expect that to translate into demand for those goods?
Yeah, so on the cement side, I definitely see the U.S. importing more. There is a slight amount of domestic capacity that could be elevated, but for the most part, you're going to see any new cement be imported. It's more cost effective to do it that way, and quite frankly, I don't see new cement plants being built in the U.S. because of environmental issues and the whole desire to lower our greenhouse gas emissions here in the U.S. So I still believe it will come from Turkey, from Greece, from Vietnam. And if the infrastructure bill does go through, you should start seeing this in maybe late 2022 into early 2023. That's when you'll start to see the numbers move up even more. Now, having said that, again, even before this infrastructure bill, we're seeing cement volumes up quite a bit, really starting late last year and into this year.
Yeah, you take a look at what's happening in the U.S. housing market. You take a look at what's happening in the global housing market. Certainly a lot of evidence for that demand picture you're painting, John. Great to catch up with you. Thank you so much. Really interesting, setting the scene for actually what is happening behind the scenes. John Webben-Smith, the CEO of Genko Shipping. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Worldwide sales at Volkswagen have taken their first significant drop this year. They fell 19% in July. CEO Herbert Diess had warned that the global semiconductor shortage would hurt VW in the third quarter. The big drop-off came in China, where sales plunged 28%. Cigarette maker Philip Morris International has moved closer to buying a British maker of asthma drugs. The board of Vectura Group backed the tobacco giant's $1.4 billion offer over a lower bid from Carlyle Group. Neither bidder can raise its offer further. Evercore has fired the latest shot in the battle over Wall Street salaries. The firm is boosting pay for first-year investment banking analysts to $120,000. Meanwhile, Guggenheim Partners raised its base salary a second time since May to $110,000. It's all about retaining talent in a record year for deal-making. And that is your latest business flash. Kaylee, Guy?
Ritika, thank you. Guy, I find this story hilarious because this whole race to pay junior bankers more really started with that deck from junior bankers at Goldman Sachs complaining about how miserable their lives were and how they have to work too hard. And Goldman was a really late mover in raising salaries. It seemed like they wanted to see what everybody else did first, and then they upped them, went to 110, and then you get Evercore and Guggenheim being like, oh yeah, 110, and we'll even raise you on that.
Yeah, it's an arms race or a game of poker. I don't know which way you want to look at it, but certainly if this deal flow continues at the rate that it is at the moment, you're going to need these people to do the work. And you don't want them moving, you want to retain them. I just wonder whether or not we are reaching the limits of what people are prepared to pay. As you say, it seems to be incrementally going up. Maybe it seems that kind of an extra peloton here and an extra peloton there probably isn't going to cut it either.
Yeah, you got to give them incentives where you can if it's not going to come from just salary. And then, of course, bonuses are an entirely different part of this equation, Guy. But I think it's interesting because obviously the banks are competing with themselves on this front, but the banks no longer just have to compete with other banks. There's fintech, there's technology more broadly, and that's also part of this talent competition. And then you have to compare the salaries of not just internally amongst the banks, but also what someone could get in Silicon Valley.
Absolutely. In fact, I think it's probably broader than that. You look at what is happening. If you're a chemical engineer or if you're a physicist coming out of a university, where do you want to go and work right now? Traditionally, you might have ended up on Wall Street. You're good at math, you could do it. That's the place you ultimately ended up. But maybe these days, no. That's a completely different narrative. It just shrinks the gene pool a little bit down. It's going to be fascinating to see where it all ends. Anyway, the European close is coming up. European equities continue to roar forward. This is Bloomberg.